Hello, this is Blake Boss, and today I'm going to be talking Ford. And what am I going to be talking about Ford? I'm going to be talking about that 800-pound gorilla standing in the back of a room that you should know about. And what is that 800-pound gorilla? It's a pension. And while there's been a lot of media coverage about Ford's pension, I don't think it's been entirely, I don't want to say honest, but hasn't told the whole story. So arguments stating pensions will turn to surpluses have recently came up. You know, it's been well known that Ford has a dramatically underfunded pension, and that, you know, the argument is that higher interest rates in the future will make that pension liability decrease, therefore making that pension possibly turn to a surplus. But I feel that only tells one side of the equation. You know, the liability side is one thing, but we have to look at what kind of assets Ford is holding. So, pensions can have a dramatic impact on companies' earnings, and lower interest rates can cause funding issues, not just with the liability. So companies usually hide in comprehensive income what they're contributing to pensions each year, so it's excluded from EPS and not hurting that, you know, ever-present EPS number that Wall Street looks at so much. And they also bury it in the footnotes in the 10-Ks that really break down the pension, what the holdings are, what their implied rate of returns on, and shareholders can get a lot of color from that. So looking at the pension assumptions of Ford, they're expecting 7.5% long-term returns. They're currently 80-20 fixed income to equity, so 80% in fixed income, 20% in equity. I feel like that 7.5% is pretty unrealistic considering past return and current conditions. Long-term total returns on the S&P 500 are around 9.2%. That's with dividends reinvested. Corporate bonds, you know, that's not even looking at treasuries. Treasuries are a little lower. Corporate bonds generally return around 6%. And, you know, you could say that that's pretty high considering current interest rate environments. So even using the S&P 500 and corporate bond rates at an 80-20 mix, you're looking at about 6.8% long-term returns on that. And Ford's assumption is 7.5%. So I think that's pretty high, and that 6.8% is skewed pretty high too, especially considering current interest rates. So the pension liability also comes down when interest rates increased. So you're going to see things kind of move in tandem. So the liability will come down, but also your returns are going to come down over long term, especially with an 80-20 mix. So Ford shows an estimated $56 billion in pension benefit payments over 10 years into 2022. And they'll pay about $5 billion from cash and equivalents in 2013 alone. That's a significant hindrance on the company, hinders their mobility, makes it so they can't spend as much on the turnaround that they're continuing to go through and investing in the new models. That's actually, that $5 billion is just as much as the capital expenditures in 2012 alone. So these are huge numbers there. And hopefully, you know, we'll see the pension kind of stay level, but I think the argument that the pension will turn into a surplus if interest rates rise is an ill-founded argument and kind of misleads shareholders. This is a continued problem, and funding this pension is going to be a big deal going forward for Ford, and Ford shareholders like to see buybacks, like to see them tackle it aggressively because it's not going anywhere anytime soon. But be sure to check back in with the Fool soon. We're going to be digging real deep into the Ford pension issues, giving you some more color there, making you feel better, making you sleep better at night. So check back on that 800-pound gorilla of Ford's. Thank you for watching, and Fool on.